Hey, good afternoon. Happy to see you. This is our next episode, episode 3. Yeah. So in our previous slide, I introduced accounting equation, and then we explained what assets are, liabilities, and capital. If you don't know what those things mean, just kindly check out my previous video so I can be able to follow up with this class. Now, today we'll be diving in a lot more deeper so that we can be able to practicalize how this accounting equation affects a businessman on a day-to-day basis. Now, this accounting equation, like I said, must always balance. And you can use the image of something like this, whereby you're holding something. Now, both sides must always balance. If one goes down, this one must do something for it to come down into balance. It's like see it as a scale. Are we together? So you must always balance. You can see here is balance, meaning everything is equal. If there's any adjustment in the assets in the course of a business transaction, another part of the equation will be affected, so that at the end of the day is going to balance. Are we together? And this brings us to what I'm going to call double entry principle. And that principle states that for every debit entry, I'm going to use DR for short, there must be a corresponding credit entry. That is what is going to help balance the equation. Are we together? If I'm too fast, please let me know. Let me recap that again. I said in accounting, this equation must always was balance. And I use this as a scenario whereby, let's say you drop a stone, for instance. So let's say there are 4 stones here initially. 4 stones are here before. Are we together? I have 4 stones here before. Now, if for any reason you take away 1 stone, let's say -1, you will now have 3 stones. Now, at this point, this is going to be a lot more lighter. So there will be a possibility of this weighing balance to go more upward, because here is having 3 and here is having 4. But because the equation must always balance, something must happen to this side to give us -1, so that we might have 3, 3. So that at the end of the day, the equation will balance. Hope this makes sense. This is just for us to understand the accounting equation and the issue of debit and credit, because anything you do in accounting, it must balance the account. At the end of the day, your asset must equal your liability or capital. Let me give you a very typical scenario. So let's say, for instance, you had assets, you had 1,005, 1,500,000. That is what you had at the beginning of the period, okay? And we borrowed 500,000 naira as a loan, and you had 1 million naira introduced into the business by the owner of the business. Are we together? Now, if for any reason now your assets reduces, what can reduce your assets? Several things can reduce your assets, but I'm going to give you a very simple logic for us to understand increase and decrease in assets. Now, whenever your assets increases, let's say, try to take a very typical scenario. So let's say you had need to, whenever your asset increases, it means that either of these will increase. One of them must increase, because it must always balance. So let's say instead of having 1,005 assets, you now have 1,006. That's increased by 100,000, right? Okay. So it means that this 500,000 naira now plus 1 million plus 100,000, because it must balance. So whenever your asset increases, there must be a corresponding increase on this other side of the equation. Are we together? That same thing. For any reason that your liability increase, let's say instead of having 500,000, you now have maybe 700,000. You had need to borrow more money from the bank. So for me to break it down, let me just say 500,000 liability, right? That's what you had at the beginning of the day. You now have extra 200,000 liability. You still have your 1 million naira and the 100,000 naira we had before. Because the equation was always balanced, it means that what you're going to have here at the end of the day is going to be what? 1,800,000. So whatever happens in your business, these two sides must always balance. Are we together? These two sides must always balance. Hope we're getting value for our time. Now, this effects that are seen of increase here and the corresponding increase here, as you can see, is going to lead us to knowing a very important principle in accounting, which is called what? Principle of double entry principle. That is going to be our next topic. So let me wipe this away for us. Let me clean this away, clean this up so that we can get into that topic. I will still leave this for us. So we are going to a very important topic, which is our double entry principle. Now, this principle is what guides everything within accounting. Accounting is not difficult. You just have certain principles, laws. Let me say laws so I can understand it. Laws that you must abide with for you to have everything normal, for everything to go well in accounting. There are principles that guide everything you do. Now, the double entry principle states that for every debit entry, there must be a corresponding credit entry. Before I get into this, let me explain what debit means and what credit is. Now, in accounting, we prepare accounts, and this is the basis of what you prepare. It's called a T account. Are we together? Now, the left side of this T account is called your debit, and the right side is what? Your credit. Now, depending on the kind of account that you have, whether than as let me still write that assets, because we always need it. Let me still write that assets equals to liability. Let me put it here. Let me make it short plus our capital, because we need it all the time. Now, for every debit entry, there must be a corresponding what? Credit entry. Are we together? For every debit entry, for every transaction that goes to the left side, let me put it that. For every transaction that goes to the left side of a T account, there must be a corresponding entry in the credit side of another account. So in business, let's bring it down to normal practicality. In business, every transaction you occur, every transaction you do would affect two sides of the account. One side will affect one account, another one will affect another account. So the debit side will be affected of one account, and then the credit side of another account will be affected. Hope I'm making sense. Now let's say, for instance, the owner of the business had more capital to introduce into the business. Now that capital I introduced into the business, let us say it's 100,000 naira. Now, capital, by general laws of accounting, let me bring out that law. That law states that assets, when your assets increases, for any reason your assets increase, you're going to debit your asset account. Just note this down. Are you together? Why? For any reason that your asset will decrease, you're going to reduce the account. So for your asset to increase, you debit your asset account. If something happens in the course of the business and your asset decreases, it goes down, you're going to do the reverse. you're going to credit the asset account. Are you together? Now, what would make your asset increase? Asset means things that you owe, that belongs to you as the owner of the business. So let's say you had a stock before of say 5,000 naira. That's the inventory you had before, or the stock you had before. And then you receive some money, say maybe 5,000 naira. And then they told me to spend 5,000 naira in buying shawarma. Let me invest that 5,000 naira and go and buy more inventory. Now, by virtue of buying more inventory, the inventory has increased from 5,000 to 10,000. So you have additional 5,000 naira inventory. So your inventory is now worth 10,000 naira. Are we together? Now, because your inventory has increased by 10,000 naira, you're going to what? Debit your asset account. And that means you're going to write whatever you have on the left side of your T account. Let's assume that this is your inventory account. AC is for short. So you're going to have what? 10,000 naira as an inventory. So you're able to have more inventory as a result of having purchased. Maybe you receive cash, like I said earlier. You receive cash of 5,000. That's what I said earlier. So that means this account now has 10,000 naira. That's what is in your inventory. Now, because every transaction occurs two sides, or rather affects two accounts. The first account that has been affected, as you can see here, is our inventory account. They've been affected. You have a cash of 10,000 naira because of this. Now, because you have a cash of 10,000 naira, that means money left you. Are we together? So you can see that this account is increased by 5,000. That's gone up. If you use a scale balance, for instance, that means you have. Let's assume that we have 5,000 naira. Let's just use the scale as an instance. So we now have extra 5,000 naira. By virtue of this one will have more weight, so it's going to go down more. Now, for it to balance, which we always say, now the cash account will be reduced. Are we together? So in this case, our asset increased by 5,000 naira and our cash is reduced by 5,000 naira, because everything that happens in accounting affects two sides. One will go up and now will go down. When I say up, and I mean one will increase and that one will decrease. And because it must balance, one must increase, the other will decrease. That is the only way for the account to balance. Like in this case now, we had 5,000 naira as the additional asset you are going to buy. I'm able to buy it because we removed 5,000 naira from the cash. So that means our cash has reduced by what? 5,000 naira. And that means that if I have my cash account now, as the case will be, two accounts are being affected. I'm building double entry principle now. You can see that two accounts are being affected. Your inventory account has been affected, has increased, and then your cash account is another account that also was decreased. So under cash, we have what? 5,000 naira. On the credit side, and what's the responsibility? Because I bought inventory of 5,000 naira. So you can see the double entry principle playing very well here. The asset account for cash for inventory increased by 5,000 naira. We gave us 10,000 and now reduced the cash account by what? 5,000 naira. So at the end of the day, our double entry principle has balanced. A corresponding debit and a corresponding credit entry have just occurred. So this is how you do everything in accounting. As long as you're in business, you're buying, you're selling, as those activities are going on, one account is increasing, one account is reducing. One account is increasing, one account is reducing. There are instances whereby one account will increase, another account will also increase. It will happen. So that is about double entry principle. It states that for every debit entry, there will be a corresponding credit entry. So every account, every transaction affects what? Two accounts. One will be debited, as you can see here, and one will be credit, as you can see here. Hope you are enjoying our class and you're having value for your time. If you're having value for your time, I want to encourage you to consider subscribing so that you can watch other videos and know when we have our new videos and learn also. So this is a scenario of double entry principle. Okay, you receive the cash of 5,000 naira, and you don't want to spend the money. I want to invest that money into the business. So that money has left cash and has gone what to our inventory. Are we together? All right. Now, another thing can happen. You could also have an expense. These are things that could make your asset increase or decrease. So you have an expense. Let's say, in the case of inventory, you went to buy it. It's an expense. Not an expense per se. Expense has to do with, like, when I say expense, I mean like maintaining the environment, maintaining your shop. That is expense. But even stock is an expense per se. Are we together? So this is how double entry principle works. Double entry. For every corresponding debit entry, there will be a corresponding credit entry. Are we together? So we're going to stop here for our double entry principle while I give in more flesh to this increase and decrease in assets. So let me clean this up so that we can know what to do whenever our assets increase without having to cry it. You will know whether I should debit the transaction or credit the transaction. So now for assets, all assets, whenever your assets increases, like I said earlier, you're going to debit it. Okay? But if your asset decrease, if it goes down, like in that scenario, cash is an asset, it went down, you're going to what? Reduce it. So when your assets also decrease, all these things can either increase or decrease. So if it increases, you're going to debit your asset account. Meanwhile, if it decreases, if it goes down, like in case of that cash we saw, you're going to credit your cash or asset account, as the case may be. Are we together? Now for our liabilities, that is things that we owe. When your liabilities increase, you're going to do what? Credit your liability account. So that means if this is my liability, let's say loan. Loan is a liability, right? We say we'll credit. So you're going to come here and credit. But this is the credit, this is debit. So let's assume you had a loan of 5,000 naira, for instance. At the beginning of the period, a loan of 5,000 naira. Okay? Now, you had to borrow more money from the bank. You went to the bank and borrowed extra. An example, borrowed extra 1,000 naira. It's going to be on the credit side of the loan account. Why? Because the law states that whenever your liability increases, you're going to debit your liability account. Now, when your liability reduces, when this liability reduces, you're going to do the reverse. You're going to debit it. You will do the what? The reverse. You're going to do what? You're going to debit that account. So let's assume at this stage our liability was 6,000 naira, right? Now let's say you received, say, 4,000 naira from a friend. Someone just dashed you 4,000 naira. And you say, this I was spending this 4,000 naira. Let me use this 4K and pay the bank the money I'm owing them. Now if I go to the bank to pay them 4,000 naira, it has reduced. So I record this reduction on my debit side. The transaction is being recorded on the debit side because your loan has reduced. And the law says that when your liability reduces, you debit it. This law will guide you so you don't make mistake when posting your transaction. Because most times people make mistake when posting. And you post wrongly, if you debit wrongly, meaning if you debit the wrong account, it's going to spoil everything. Your account will not balance. And because our aim is to balance, you must learn these laws. These are like the laws for double entry to guide you. This is the law of double entry. For every corresponding debit entry, there must be a corresponding credit entry. But how do you apply it in your day-to-day business? That is where this comes into place. So if your assets increase, you debit it. If they go down, you credit it. If your liabilities increases, you debit it, as the case we shared. And if it goes down, you're going to reduce it. And for your capital, the same thing that happens to liability happens to capital. So when your capital increases, you're going to what? Credit it. And when your capital decreases, you're going to what? Debit it. So let's give ourselves, and let me give you a clear example. So let's say at the beginning of the period, you had a loan, or rather a loan, you had a capital of 10 million naira. Capital account. Excuse me for 5 minutes, please. Just 5 minutes. But let's round up. So let's say you had a capital of say 5 million naira before. And then you had a need to borrow extra 1 million naira from the bank. So it's going to increase. You now have, sorry, not a loan. You now have, not talking about loan. Let's say you had a capital of 5 million naira before. And you now had extra 1 million naira. You want to put that 1 million naira into your business. It's going to what? Increase. So you now have what? 6 million naira. This 6 million naira is on the credit side of your capital account. Now, if for any reason your capital reduces, whatever reason, something happened and your capital reduces, you're going to what? Debit it. So let's say something happened and then you lost, or rather, your capital reduced by 2 million naira, you're going to credit. You will now do what? You will now debit your capital account. Now, what can make your capital reduce? Capital can reduce for several reasons. We'll talk about that in our next slide. But I want us to understand this law so that I can guide you when preparing your account. So very quick recap. Whenever your assets increases, you're going to debit the asset account. When it reduces, you credit the asset account. When it increases your liability, you credit it. And when it reduces, you debit it. Are we together? The capital account, when it increases, you credit it. And when it reduces, you debit it. I hope you have learned something today. Practice what you've been taught, and accounting is not difficult for us. Accounting is difficult when you don't practice. But if you've been taught something and you practice it immediately, you will not forget it. That I assure you. Don't forget to subscribe and like. I'm not going to be making out time to watch my video. See you in my next class. Bye.